Yeah, I think people think we're just so biased to retail that we just only want to buy retail because we like retail or we know retail. I would love to buy apartments. I would love to buy the small bay light industrial stuff. I see these companies that do that stuff, and I'm equally as amazed as I'm sure people are that look at what we do. And that's what this podcast is about, is trying to break that barrier of it actually is possible. You know, there's the rent growth story. All right, what is up? And welcome back. Well, we have a fun and exciting topic today, but first, we just closed on Lakeshore Plaza in West Palm Beach. Super excited about that.
Yeah, man, I am. West Palm Beach is a nice area. Not as nice as Palm Beach.
Got some value add there, I think.
Yep, nice story. Renovate the property, raise the rents.
Better management.
Way better management, better leasing team. And then this week, we are closing on Champions Terrace.
That's next week, yeah. It'll be our second deal of the year, closed by middle of February.
Yeah.
So that's awesome.
We're on our pace of one a month.
And we're on our pace of 100 mil.
And we have one in March.
Yeah, that's the Reno one. So the Reno one is up, fundraising now. If you catch this in time, you may be able to get the last spot in Champions Terrace, that Houston one. We opened that up to non-accredited investors, which I'm super excited about. We have a lot of those guys constantly trying to get in the wrong deal.
Yeah, we have some space left in Champions.
Yeah, for them. What else? But distributions went out. Yeah, it was the biggest quarter yet in distributions. I think it was like $770,000.
Man, that's crazy.
That's nice.
Just in cash flow in one quarter. A lot of properties, and we've added several more since then. So
that's why we tell people to invest in multiple deals. Don't invest all of your cash into one deal. We recently had a development not go the way we wanted it to, but when investors see us distributing $750,000 in a quarter, there's a lot of investors that are in 5, 6, 8, 10 deals. And so they've got a really good chance of getting a bunch of distributions. And so we always recommend getting into as many deals as you can and diversifying that risk.
Yeah, we're doing a lot of cash flowing deals. I would say everything we bought last year and now is paying out a good return, right? We're hitting the pref. It's cash flowing great. The renovations are going good. The lease up stories are going good. We're doing a lot of new leases on the stuff we bought last year, which is really exciting. Got some momentum going already. Refinancing Landon already. We just bought that thing. Anyway, what's next?
Well, let's do put a cap on it first.
I absolutely dominated Brian last time, so let's see if he can save his dignity and come back.
Yeah, I'm sure I can.
All right, let's roll through it. I got 3 good ones. Now, you guys should have taken a quick look at this before, but the first one is Cove Creek Commons in just outside of Huntsville, Alabama. It's about a 15,000 square foot retail center built in 2020. It's 100% occupied, and it's got 126,000 people in a 7-mile radius. So, they went 7 miles. It's normally supposed to be 5. But the average household income within a 3-mile radius is 172,000, guys. Okay. That's huge.
And I like Huntsville.
And the traffic counts are 33,500. Not bad. So pretty solid. It does sit sideways to that traffic count, and it doesn't look like it has a real direct access. If you see the picture, we'll put a picture up on the board. It's nice
looking. I don't like the side access there.
Yeah, that's tough.
It's like a metal building with lick and stick brick. Let's be careful using the word nice.
Yeah.
It's a newer building.
Yeah.
It does have some rent growth. The rent grows about 30% over a 10-year hold. So not great, but not terrible.
Most of the 30%, 10 years, you lost me.
Yeah, I mean that's not even 3% compounding over 10 years. So it's all triple net leases. Does not include management. There are some decent size increases early, like the Bloom Wines goes up 6 to 8% here this year. Not sure if they factored that in. They all have increases, but some of them are like 10% every 5 years, which isn't great. What else you guys want to know about it?
I think that's good enough for me.
Yeah, what do you got?
I got a guess.
What do you got? I got mine written down.
Okay, I wrote down.
You got it written down?
Yeah.
Okay, I'm going 715 on that one.
I wrote an 8.
8. What do we got, Joel?
It's probably they're probably asking 7.5, maybe
6.75 on the ask.
Oh,
another victory for Brayden.
Well, utter domination.
Okay,
I think I'm
We're going to keep moving. Brian's got, he says he's going to use the drug excuse.
Yeah, that's okay. It's
All
okay.
right, next one is Findlay Marketplace in Findlay, Ohio. And that's Findlay. Findlay?
Yeah, I've been there.
Yeah, well, it's a pretty small market, to be honest.
Yeah.
But not a bad center. They got some decent tenants. So let's talk population. Well, in 5 miles, you only got 50,000. In 10 miles, you only have 65,000. So you're really in a kind of a remote, small market.
All right.
Average household income, though, is good. Within a 5 mile radius is 100,000. 30,000 square feet. You do have good frontage. Let's talk about some of the tenants. I think Miracle Ear, I know it's a little weird, but I think it's a good tenant. They're sticky. AT&T is a good tenant. Jersey Mike's is a great tenant. It's on a long-term lease.
They make a good sub sandwich.
Yeah, Sports Clips is a pretty national brand. You got the Army National Guard, which has got credit. Armed Forces also has credit, and they're all triple net except for a couple of them. So,
Was this the one by what's like across the street? Is there any major retailers across the street?
yeah, I mean, this is, you can see it's a small market, but this is where the retail is in this market.
Yeah, it's popping.
It's popping there. It's 21,500 cars a day, and you are dead set frontage.
kind of hedging this a little bit. So
I've got a number.
you got it written down?
Yeah.
Okay, I'm gonna go 7.5.
Okay, we're close. I wrote down 7.75.
Okay, let me tell you.
Close. This is gonna be interesting. Close enough to make a ball
They're
game.
probably asking 7.5. They're gonna.
Why
They're
is
gonna. They're gonna go low.
What'd you say?
7.75.
What'd you
7.5.
say? 7.5.
Ooh, 2 for 2.
Man,
I think I'm doing.
you
what
were closer.
I don't even know if we need to do
I
the
think I'm
third.
doing what I would.
I already
pay for
won.
it, maybe.
Yeah, you got to do what they're asking
I
for.
gotta reduce
We're gonna
mine.
do the third, just see if I can get a clean sweep.
Okay, let's see. The last one is Hamilton Center in Sioux City, Iowa. And for those who don't know, I looked it up. MSA, Sioux City is like 150,000 people. So it's not near as small as the last market. It's not huge. You got 31,000 vehicles right in front of the center. So that's really strong. A lot of retailers in the area. One thing that's interesting about this is it has the backside has a 2 levels. The backside is kind of a basement level, which isn't great.
I don't like that.
40,000 square feet.
I don't see the levels.
Yeah, don't see no
I
levels.
don't see no levels.
Let's see. You have a tires in the back for as like kind of a separate building for 8,000 square feet. You might be able to parcel that off. Not sure about their credit. And then you got a couple of big tenants of 5,000 square feet, but most of them are 15, 1,000, 2,000. So what else we got here?
Do they seem to be below market rents or?
Rents are, for Sioux City, I haven't done a lot of research, but you're in the $10 to $14, $10 to $15 range.
All right, 7.75.
I'd go 7.95.
All right, let me tell you what that is. What was that, the Hamilton Center?
This could be close. I think they could have priced it lower than I thought.
Yeah, that's what I'm thinking. They want.
Oh, real quick, 5 mile population is 100. 5 mile household income is 75,000.
It's not bad.
All right, listed at Nate Cap.
What'd you say? 7.5?
7.95.
Oh yeah. Well, I think you won that.
All right, now let's get into the main topic. Another win for Braden.
Okay, so I thought it would be interesting to go and measure a year ago and today, just some interesting stats in the market. What I think are interesting that you should kind of be watching. The first one is the S&P 500. So today I pulled it up. And obviously, it's gone down, a few points just recently. But today it was priced at 6,808.50 cents. A year ago it was 6,061. So up 12% from a year ago, S&P 500.
Okay.
Nothing amazing, but above the average.
It's okay. Yeah.
Yep. Inflation. This is an interesting one. Today, 2.86%. A year ago, we were at 2.9 to 3%.
So kind of pretty steady.
Yeah.
Trending down 10 bips. Prime. A year ago, we were at 7.5. Today, we're at 6.75. That's good.
Okay, that's expected.
Yep.
Probably.
I bet the Fed holds their decision in March.
Yeah.
You guys not one to
Until
ruffle
the
any
new
feathers.
Fed chairman gets in, and
We'll
then
really see if he's an errand boy for Trump, if he just immediately lowers rates.
doesn't Trump sign
Picks them.
picks him?
Yeah, but I don't think the Fed chair doesn't decide. They vote.
Yeah.
So it's, he may have sway, but he doesn't get to ultimately decide.
And he seems to have some rationality to him. I don't know if he's going to be
I think that's
easily bullied. Gold. This is an interesting one, guys. $4,850 for an ounce of gold today. A year ago, it was $2,893. That's a 68% increase.
Wow.
68%.
Damn.
What's that tell you about the fear in the dollar and in the U.S. economy?
The dollar and the economy. Yep.
Silver. This one's freaking nuts. It's hard to buy and sell silver right now because it's so volatile. Today, it's at $74 an ounce for one of those little silver coins. $74. Freaking nuts. My son has got a little silver collection, so I've been letting him know, and he's like, no way. He's freaking out. Anyway, a year ago, it was $33 for that same ounce of silver. 125% increase.
But it was at 115 recently.
Yeah, like all of this stuff has come down.
And also, and by the way, since you looked at the numbers like 30 minutes ago, it's already down to $71, $72.
Okay.
So moving quite a bit.
But go back 20 years and the increase is not that much.
Not that much. It was pretty flat for a long time. This is kind of looks like a silver bubble. Yeah. What else you got for us, Braden?
Bitcoin, 63,000.
Ugh, hurts.
Yep. 1 year ago, it was 96,000.
Bitcoin's at 63,000?
Yeah, it was 126. Now it's at 63 and kind of free falling. So
down 35%.
Don't ever listen to me when it comes to crypto. I think I know what I'm talking about, and I don't.
Anyway, that is our market stats. We'll track that throughout the year and just kind of refer back to the starting stats of the year. I think it'll be interesting, kind of measure how everything is doing.
Yeah, so main topic for today is why does small retail outperform? And what do I mean by small retail?
Outperform other commercial real estate?
Yep, outperform other commercial real estate asset classes. And what I mean by small retail is a lot of what we buy, neighborhood shopping centers. I'm not talking about huge power centers, huge regional retail centers that have a lot of huge big box tenants. I'm talking about your inline retail in your neighborhoods with a lot of tenants that take up a small share of the retail. Yep. So let me just give you a couple numbers. Strip retail was plus 5% over the last 12 months and only down 7% from its peak in 22. Compare that to apartments. Apartments are up 0% over the last 12 months, and they are down 19% from their peak. Office is down 35% from its peak. It's getting decimated.
Yeah.
And so what we're seeing is retail, especially small strip retail, is outperforming most retail asset classes at the moment. Let's see. What is causing it? Supply is structurally constrained. And so, there's two things that are constraining the supply. First of all, retail tends to go in clusters. And what happens, retail wants to be next to other retail. Well, once it's all built out in that retail corridor or sector, they're not able to make a bunch more of it. But with like apartments, they're not as focused on the location. Okay, and so you can just keep building apartments kind of around that retail hub, and there's no real limit. You can just go another mile and build another big apartment complex. So that supply kind of outpaced. And where strip centers didn't, and so you're seeing more upward rents now in retail than we're seeing in the other asset classes. Let's see what else we got. First of all, what do you guys think? Does that resonate with you guys? Thoughts?
Yeah, it does. I definitely have seen rent growth stagnate in the other asset classes. I think Oklahoma specifically has still been doing really strong last year. I saw double-digit rent growth at one of the forums or luncheons or whatever. But yeah, it makes sense. There's no doubt this stuff is really expensive. And I think in retail right now, you're having a shift of good retail and healthy retail. So there's a lot of backfilling going on. So while it's still growing, it's not necessarily in a sense of bringing new supply to market, like you were saying. It's in a sense of how do I get rid of some of the unhealthy tenants? Like we're still seeing some bankruptcies in retail. We're still seeing tenants go dark. But for us, it's been good because we know that there's good, healthy either emerging tenants or tenants that have been around for a really long time that have gotten it together and are starting to expand, that are willing to pay higher rates. So it's been a good thing. It's not yet to the point where the demand is so high where they're willing to pay anything, because there's some unhealthy tenants out there in the market, a lot of them, that have just gotten hammered. Like we saw Joann's declare bankruptcy last year. There's a bunch of other really big ones that I'm just blank. Party City was another one that had a lot of junior box, 10, 15,000 square foot suites. And again, I think that's why we strategically stay away from that more so than the smaller stuff, because your buyer pool or your pool of potential tenants with a 2,000 square foot suite that can afford $5,000 a month is a lot greater than a 15,000 square foot box. Like that's a very specialty use. And there may be all of the discount gyms already in your market. So you're backfilling it with a higher paying tenant. You have some free rent period. You may have some permitting period. You may have a contingency period, but ultimately the value of your center is going up because you're getting that rent pop there.
Well, there's a much broader market. So I think there's not as much volatility as some of those others, right?
Yeah.
Well, and so a couple other keys. Let's take apartments, for example. And whatever we say about retail today, all of these markets are cyclical. So just because apartments got overbuilt, and caused depression or slower growth in rents doesn't mean that's going to be the case 5 years from now. We're talking about like today. But apartments through COVID, when that money was dirt cheap, apartments got overbuilt, and so we're kind of seeing that now where interest rates are higher and apartment rates are struggling to get that rent growth that they need to kind of overcome the higher interest rates. But another thing is we've also seen expenses go through the roof. Doesn't matter, construction, HVAC equipment, utilities and contractors, and apartment owners can't pass that on to the tenant. The only way they can get it is by increasing rent.
Right.
But with the retail that we buy, it's all triple net. So those expenses are getting passed on to our tenants in addition to the rent growth. We may have the built-in, rent increases, but we also they have to pay their share of the cost, the triple nets. And so it's just an automatic pass through. And so we're not getting hit with some of those cost increases that some of the other asset classes are. Office is the same way.
Yeah. And you can look at a good multifamily year of 10 or 15% rent growth, which a lot of multifamily owners have seen in their hold periods over the past 5 to 10 years in a single year or a year or two. But when you look at insurance going up 30 or 50%, it nets even, right? You're making the same amount of money. So it's worth more in the capital markets. But then again, they're still underwriting a higher rent number. So it just puts pressure, whereas like you said, the structure of a true triple net lease, which you see in other asset classes, you see industrial leases, triple net a lot of the times. I've seen office leases that are triple net, especially now more than ever. But yeah, that's a massive advantage of having a triple net lease is you're truing up costs. You eliminate your exposure of a super inflationary environment.
Yeah, and so we see the foreseeable future with the multi-tenant retail that we're purchasing of strong rent growth. We're not being affected by expenses. So we have stable expenses. Even if you think about like a multifamily property and all the staff you have to manage it, all those salaries going up. Well, you don't really have that with retail. You're not really have a salary. You pay a management fee, but that fee is set and it's on a percentage of the income. And most of the time the tenants pay that too. So
you would be amazed at how good a tenant takes care of their property when they know they're paying for it. Like, hey, the parking lot's dirty. Sweet. I'll send somebody to clean it up. They know they're getting 20% of that bill because they have 20% of the center. They're probably just going to pick it up themselves. Yeah. It leads to a healthier culture. And then just across the portfolio, I know of 2 suites right now in different centers that we have 2 different offers on. They're vacant and we have 2 people bidding on them. They wrote us full price asking offers on what we wrote. And we're going back to both of them and saying, who wants to pay more? Because we've got the suite, right? And that's what we're seeing in retail. Like you've either got the spot and you can lease, or you're just not getting phone calls.
Of course, some people will say, well, I see, vacant retail all the time, right? We agree. Yeah. But we're not buying that. And if we are, we're getting at a good deal and it's a good location and we're going to backfill it. But in any event, we feel like the market signs are positive for the assets that we're buying. We're seeing it every day in the renewals that we're doing and in the interest in the vacancy that we have. And so I know if I went out and I tried to find articles that said why another asset class is the best, I probably could find it. So, we're not saying that this is the only opinion out there, but we're just trying to present an argument that supports our thesis that neighborhood retail with limited big box in well-populated areas with good traffic counts and decently high household income, we think that is a great place to be, and a lot of the market agrees with us.
Yep. What we're doing.
Just at a macro level, it's rare in digging through multifamily and retail deals all these years. It's rare that you find a multifamily owner that's so stuck in the Stone Age that they don't increase their rents. Like generally, they're pretty close to market. Retail, you would be mind blown at the owners of these neighborhood shopping centers. It's a group of 7 children. It's an old man who lives in Spain. It's some dude who retired and now lives in Puerto Rico, and he's owned it for 30 years.
Yeah, they're not putting a lot of effort into it.
Yeah, they don't put TIs. They don't raise rents. They hire the crappiest company in town, and that just never calls them or something. You would be mind blown.
I wonder. I'm trying to think of why that might be, and I maybe because retail is so
more passive.
Yeah, it's so hands off.
Yeah.
That once you're hands off and you're getting this mailbox money and you're not really having to do anything, why rock the boat?
Yeah.
If I go and I try to press this tenant on rent, then I might lose them, and then I got a vacancy, and that unknown factor in their mind.
That's
they're like,
a hassle.
I don't want to deal with that.
Hassle. Yeah.
Well, and I think historically, retail as an asset class was a preservation of capital, 1, but 2, a really good dividend. Right. It's going to pay out 10, 12, double-digit cash on cash, or at least high single-digit cash on cash. And it's just kind of like stable. I don't think it was traditionally owned by people who wanted massive rent growth. And now that's the play. Right. And it was that way in multifamily before it wasn't. And I'm just saying the point of this topic is you've got to chase rent growth. As somebody who's looking for yield and buying real estate like we are, if you're looking to make money in real estate, it's all about pushing rents. So you want to go to the asset class where you can push rents the most. And right now we believe that's these neighborhood shopping centers.
Yeah, I think a lot of people are just saying, okay, well, I'll just go with whatever they offer, and that's good, and I'm keeping my tenant, and that's good enough.
Yeah, I think people think we're just so biased to retail that we just only want to buy retail because we like retail or we know retail. I would love to buy apartments. I would love to buy the small bay light industrial stuff. I see these companies that do that stuff, and I'm equally as amazed as I'm sure people are that look at what we do. And that's what this podcast is about, is trying to break that barrier of it actually is possible. There's the rent growth story.
Well, okay, so to close it up, you make a great point. I would say, let's be honest, we are in the retail space, so that's what we try to focus on. But I have another company where we buy more multifamily, and I have a business partner that is very good at managing multifamily. So put your thoughts in the comments on the video or the podcast. We'd love to hear from you. What is your opinion on the best asset class? And let's have a dialogue about it, because we think we can learn something from you. If you're having success in multifamily or industrial, we're sharing our experience, which right now is primarily focused on retail. So look forward to hearing from you guys. Anything else for this show?
That's it.
All right, till next time.